Well, hello again, everyone, and welcome to our latest market report. Dion Zakuski here with you once again, branch manager and director of Scotia Wealth. And in today's update, we want to share with you a few interesting topics. First, what's causing the market corona comeback? Second, we're going to look at the relationship between the economy and the market. Are they the same thing? Talk a little bit about strategy as well. And finally, as we're getting close to filing our taxes for the 2019 tax year, some tips to help you along there. So investment markets have been on a wild ride the last 3 months. We know this. First, we saw the fastest correction into a bear market in history. This was followed by a sharp bounce. We'll throw in an oil price crash for good measure, and now indexes are grinding higher. As we know, the main reason for this ride had to do when the lights went out due to COVID-19. At about the third week of March, most of the sellers had been shaken out, along with central banks around the world pledging trillions of dollars in stimulus measures to keep the economies from sliding backwards. Similar to what we've seen here in Canada, this included interest rate cuts, income supports, and loan guarantees. Optimism returned for the month of April, and we'll call it the Corona comeback. And no, I'm not talking about a term from boozing too much over spring break, but rather a rally off the market lows. I'm going to show you more here in this chart. In looking at the American S&P 500 index, we saw a steady climb to March, followed by a cliff. The good news is that there has been a fair amount of recovery, including further gains seen here in May. Keep in mind that our top Scotia strategists believe that the worst of the selling may be over, but it is highly likely there still could be some bumps ahead. And this brings us to our next topic. A question our team has been receiving a lot lately is, how can the markets keep going higher and higher when the economy is so bad? Many companies are reporting dismal earnings right now and large losses. Unemployment is through the roof. There's no NHL to watch. Well, there's no live NHL to watch. I mean, I'm having a great time watching some of those Oiler games from the 1980s. They're phenomenal. But anyway, Bond wants me to get back on track. So we know that corporate fundamentals and economies will stay weak for the next few quarters. Unemployment will move higher. In fact, it's predicted it may move to levels not seen since the 1930s and the Great Depression. However, we are seeing COVID curves flattening and economies are starting to open up. And here's the one thing that many people have a hard time understanding, is that the economy and investment markets are not the same thing. Of course, they're related, but they're not the same thing. Economic data is always backwards looking, whereas investment markets are always forwards looking, sometimes short term, sometimes long term. As we saw in March, the very short term view caused an overreaction of selling to the downside in investments. Now, the market is looking across the valley, past the next few quarters, and actually pricing in a substantial recovery in 2021. And that's the main reason that indexes are moving higher. Now, the irony is that whether this trend continues has to do with what we really can't see. On the positive side, that would be a COVID vaccine or cure. On the negative side, it would be if a second wave results in another economic shutdown. As investors, the best way to navigate through this is to ensure you have the proper risk-reward strategy in your overall wealth plans and, of course, in your portfolios. This has to fit to your longer-term goals, as we know, and this is an area that our team looks at on a daily basis for you. Okay, switching gears a bit, remember that June 1st is the deadline to file your personal taxes here in Canada. For seniors, a few things to mention. The Liberals have promised to increase old age security pensions by 10% for anybody over the age of 75. You should start to see those payments move higher in July. Related to payments, due to the market effects we talked about earlier, anyone required to draw from their registered income funds, or RIFs, can take a reduced payment of 25% less to help mitigate the market effects. Other items to note include an increase in the Canada Child Benefit and tax credits for jobs training. And here's a couple other things to remember during this COVID-19 time. If you're working from home, ensure you keep record of when you're working from home and costs such as utilities, internet, and that sort of thing. They may be eligible for deductions. Also, if you're receiving any of the government assistance programs, such as the Canada Emergency Response Benefit, these may be taxable to you. So just a couple things to keep in mind. Of course, always consult a tax professional in these areas. And that wraps our video for today. As always, if you have questions, contact your friends at the Zook Group. It's more important than ever to stay on a good financial track. Stay safe, stay positive, and thanks for watching.